Let's talk about second entries at key entry points. Specifically, let's talk about entries at channels. Once we've established a channel, we have to look for a signal at the key entry point. What is the key entry point? Well, here we have two of them. We have the 20 EMA here, and we have the channel line here. Now, because this right here is a bull channel, we're really only looking to go long here. Now, if we look back at this channel, you see some specific areas here, 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 and here. And you could make a claim for here too as well. What's unique about the placement of these? Well, they're all at 20 EMA. This is one form of a channel that we can have where we have a lot of entries at the 20 EMA. With that being said, though, we're generally not interested in anything that's in the middle of a channel. We were to draw out a midline. Sometimes we have some midline entries as well. Midline and 20 EMA are sort of the same in this situation. We could say maybe here, 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 entry here. There's a few examples of a possible midline. But what we want to focus on really is this bottom line here. Start counting entries real quick. Push down, push up, creating a first entry. Bull bar pushing down. Once it pushes back up, it creates a second entry. Second entry long here. Not a bad little entry. We have a pullback. We have first entry off the 20 EMA. Another pullback. First entry off the 20 EMA. Why is this a first entry and not a second? It's because we made a new high. Our count is going to restart once we make a new high. First entry here. And now we get up really high, relatively far away from the moving average. And when price comes back down, the moving average is more and more closer to the middle of the channel. Channels like this, it's difficult to take these entries, because if we take them in here, even if we have a second entry trigger in here, it's still difficult to take because we're in the middle of a channel. Anything can happen in the middle. But once we get down to the bottom or the top, it's likely that it's going to go in the opposite direction. Entry, entry. We get into, we might could call it a range. Breakout pullback of the range. First entry, pullback. Second entry here. This is kind of what I'm talking about with it being the middle of the channel. We have a second entry. We had a range. We had a breakout of that range. Pullback close to the midline where it found support, also on the 20 EMA. And it seems like a decent place to go long. But what do we end up getting thrown into? The small range, which eventually would stop us out and present the trade that we're really looking for right here. High here, pull back, first entry long, pull back, second entry long here. Now let's examine the context just a little bit. Let's look at our signal bar. We have an inside bar, not necessarily preferred. However, an inside bar happening at the bottom of a channel here is not necessarily a bad thing. It's not like we're in the middle of no man's land where we might get a range from this inside bar. Chances of an inside bar here leading to a range is a lot smaller, or if it does, it will likely be a small range just lasting less than 5 bars. Second entry here, where's our profit target? Profit target is going to be the high here. Where's our stop loss? Our stop loss is going to be here. Now where are we looking to take a position at? Our entry triggers when the current bar, being this bull bar right here, goes one tick above the previous bar. So if we were entering on a stop market order, we would enter here. Now let's take in some considerations with this trade. Considerations that we'll have to make pre-trade before we even think about putting an order up on the board. First things first is we have to measure our risk. If we enter here, our stop loss is here, we're risking 3 points. We have to determine if these 3 points are within our risk parameters or not. If it's more risk than what you're expecting, then I would suggest you go ahead and you start trading half size. Trading half size on extra risk allows you to still continue to get good trades in, but since the risk is so much more, instead of losing extra money, you don't actually risk any more funds when you trade half size. Now where is our first profit target? Our first profit target is the high here. Let's see how far away that is. 2.25 points here. So when we go to take this trade and we realize that our stop loss is actually larger than what our take profit is, we have to consider if we even want to be in this trade. Now you can still take this, but we can no longer use this as a profit target. We have to make a new high. And that's one of the issues with trading in small pullbacks, is we have to constantly be betting on a new high. A lot of times we don't have to do that when we have these deep pullbacks, and we can easily allow the market to go up 7, 8, 9, 10 points and make a new high, and then at that point in time, it's not as big of a deal if we don't make a new high. We don't have to bet on it. We're already 7, 8, 9 points in profit. Now, what do we need to do about this? Well, we need to look for second entries at key entry points. Our first second entry happens here. First entry, short. Pull back with this bear bar with a nested second entry. Now, what's the problem with taking this? Well, the problem here is that if we go and we draw our midline, we can see that we're trading in the middle of a channel. Not ideal. However, if we waited just a little bit longer, we have a pullback, first entry short here, and a second entry short here at the key entry point, being the 20 EMA and the channel line. Channel, second entry short, first entry, second entry. Ended up being a pretty big one. Now if we look to take this entry, let's think about some things. Where is our stop loss? Our stop loss is one tick above the high. Where is our take profit? Our minimum take profit is going to be the low here. And where is our position? Well, if we enter on a stop market order, it's going to be here, this middle line. Now let's measure real quick. If we entered here, our stop loss was here, we're risking 2.25 points. If we go off the previous low, our take profit is 3.25 points, which means in order to have a positive traders ratio, we have to look for a new low in this situation. Trend is strong enough, we'd likely get it. You can take this trade. It's a good trade to take. It's just, we have to be aware of where our profit target is. We have to be aware of where our stop loss is, and we have to make sure that we constantly have a trader's ratio. Some people are afraid of going for more points because they think, oh, well, the probability of me getting those points is really small. Okay, well, fair enough. The more points you go for, the lesser the probability that you'll actually make them. With that being said, though, if you were to go up to someone and you were going to say, every time that you're right, I'm going to give you twice the amount of money as the amount that you lose every time that you're wrong, I don't think that there's a single person in the world who wouldn't take you up on that. Let's look at this example real quick. Second entry short at a key entry point. We talked before about when the 20 EMA was kind of in the middle. That's not really the trade that we're looking for. The best trades are when we can have a channel and we can have this 20 EMA close to our channel lines. This is what we have here in this trade. We have a push up. First entry short being this bull bar. Remember, just because it's a bull bar does not mean that it's not a first entry short. First entry short. This bear bar pushed above the bull bar, creating an entry long. And once we surpass the previous bar's low, being here, this becomes our second entry short. Cool thing about this trade is it's extremely bearish, right? Because we have a first entry long, pullback, a second entry long for the bulls. Stop losses are going to be here, which also happens to be where our trigger is. And look at what happened here. Bulls who took this long, looking to fade this channel here. Bulls who took this long, trapped out bad. Market barely even retraced. Tiny tail here. Didn't even go above here. You can't enter on anything other than a stop market here. Big push down. Anytime we have channels, sometimes they're the best trades you can get because it's often relatively small risk and you can often get 2 points of support in one, channel line and the 20 EMA. Anytime you can get those together, you're stacking your probabilities. Anytime you're able to stack your probabilities, it increases the chance of this trade being an actual winner. Now if we were to take this, we would take it here. Stop loss would be here. Be looking for 4 points. We'd have to be looking for a new low in this situation. Let's look at this channel example real quick. We have our first entry long here. Why? Because this bar pushed above previous bar's high, creating a first entry. Here we have a second entry. Outside down bar ended up being bullish. Pretty good signal bar. It's really not bad at all. Second entry actually triggers on this bear bar right here. Second entry long at a key entry point being this channel line. Now even though we've broken below this 20 EMA here, we see this big break here with a bear bar closing out its low, followed by this bull bar which ended up being our signal bar. This would be a relatively good bet that this is actually a climactic bar, climactic bear bar. We're at a point of support. It makes sense for it to be climactic. Following bar ends up being a good signal bar. And we really haven't broken this 20 EMA with any form of strength. There's no follow through to it. Ends up being a good trade here. You could even say that because this is climatic, we actually have the support of the 20 EMA still, because bulls will see this as a discount and they'll look to buy. On top of that, we're still at the channel line, which is the 20 EMA, or which is also close to the 20 EMA. If we took this long, let's look at our entry real quick. We'd enter here if we entered on a stop. This is the NQ, so we're looking at 17.5 points. Not so bad for the NQ. NQ, you're probably going to average 15 to 20 points of risk. Let's look at the take profit now. 30 points of profit brings us a pretty good trader's ratio here. So we can just go for the high as our initial profit target if that's what we like. Another option that you can do is you can run multiple contracts, take profit with half of them here at the top, move your stop loss to break even, and then you can just let the other contracts run. You'll either be stopped out at break even and end your trade with a profit, or you will let your contracts go and they'll just continue higher. Depending on how strong it is, it's what you really want to do. Let's go over one more example here. Second entry long. At a key entry point, two forms of support. If you look very closely, you see that this bull bar here went above the previous bar's high. What does that mean? Well, it means that it's a first entry. So we mark our first entry. We have a pullback. We have a pullback to 20 EMA here. And then we have a really small signal bar at our channel line. And we have a bull bar here creating second entry long. It's not that bad of a signal bar, really. You look at it, you can say that, oh, well, maybe it ended bearishly, but we are only 1-2 ticks away from it ending bullishly. And that can be a case with pretty much any signal bar, and you can look at it like that. The biggest thing is that we see evidence of bears beginning to close out of their positions and bulls beginning to buy. If we look at the size and the shape of these previous bars, we have a bear bar closing at its low. A bear bar had a slight pullback, and we had another push down. Interesting note, it doesn't really matter a whole lot in this context, but big bear bars like this that close at their low, it's not uncommon for them to have a 50% retracement or retracement matching their highs, which is where limit order bears may look to sell sometimes. Next bar is third bar down, ended up being relatively small, ended up being at a key entry point too. We can easily use this as a signal bar. You're only 1-2 ticks away from it being a bull bar. Alright, that's going to sum up our lesson on second entries at channel lines. Just remember that it's best to stack your probabilities as best you can. It has to be more than a second entry. It has to be a second entry at a key entry point. Other traders who are looking to take your side of the trade have to have a reason to go along with you. And traders on the other side, they might have a reason to go the opposite way, but you have to be able to negate their probabilities the best you can.